Welcome back, everyone. Today, we're diving into a topic that honestly can feel a bit morbid and super confusing. What happens to your money after you're gone? Specifically, we're talking about estate tax versus inheritance tax. Diane, I feel like these terms get thrown around interchangeably, but they are absolutely not the same thing, are they?
You're absolutely right, Sean. It's a huge point of confusion for so many people. And it's not just semantics. It fundamentally changes who pays what and when. I mean, we've all heard stories or maybe seen movies where someone dies and suddenly there's this huge death tax bill. But what kind of tax is it, and who's actually on the hook for it? That's where the distinction becomes critical.
Exactly. Let's start with the estate tax. For simplicity, think of it like this. The estate tax is a tax on the total value of a deceased person's assets before those assets are distributed to their heirs. So we're talking about everything they owned, their house, investments, bank accounts, even that antique coin collection. It's all added up.
And the key differentiator there, Sean, is who pays it. The estate tax is paid by the estate itself. It's almost like a final bill the deceased person's financial legacy has to settle before anything goes out to the beneficiaries. The executor of the estate is usually the one responsible for making sure this tax is paid.
Right, so if the estate owes, say, $1 million in estate tax, that money comes out of the pot before your kids or your spouse see a dime. It reduces the total amount available for distribution. But here's a huge caveat, especially for our listeners. The federal estate tax only applies to, well, really wealthy estates.
That's such an important point, Sean. I think this is where a lot of the fear comes from. People hear estate tax and immediately think their modest home and savings will be taxed heavily. But federally, the exemption amount is incredibly high. For 2024, it's $13.61 million per individual. That means an individual's estate has to be worth more than $13.61 million before it even starts to owe federal estate tax. For a married couple, that's over $27 million.
Which, let's be honest, applies to a tiny fraction of the population. We're talking about maybe 0.1% of estates ever owe federal estate tax. So for the vast majority of our listeners, the federal estate tax isn't something they'll likely encounter. It's a nice problem to have, as they say.
Absolutely. But, and this is a big but, it's not just federal. Some states have their own estate taxes, and their exemption amounts are often much lower. So while you might be fined federally, your state could still come calling. We're talking about 12 states plus D.C. that have their own estate taxes. New York's exemption, for instance, is around $6.94 million, which is still substantial, but Oregon's is just $1 million. That's a huge difference.
That's a really important distinction. So if you live in, say, Oregon, and your estate is worth $2 million, you might not owe federal estate tax, but your estate could definitely owe state estate tax. It really highlights the importance of knowing where you live and what your state's rules are. Always check your state laws, folks.
Definitely. Now let's flip the coin and talk about inheritance tax. This is where the confusion really kicks in because it sounds so similar. But with an inheritance tax, it's not the estate that pays. Instead, it's the beneficiary who pays tax on the assets they receive.
Okay. So the individual who inherits the money or property is the one with the tax bill. That's a fundamental difference right there. The estate has already distributed the assets, and then the recipients get taxed.
Precisely. And here's another crucial point for inheritance tax. It's all about your relationship to the deceased. Unlike the estate tax, which is based purely on the size of the estate, inheritance tax rates and exemptions often depend on how closely related you are to the person who died. This tax is also far less common than state estate taxes.
How many states actually have an inheritance tax, Diane? Is it as widespread as state estate taxes?
No, it's much rarer, Sean. Only 6 states have an inheritance tax: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. So if you don't live in one of those states, this particular tax isn't something you need to worry about as a beneficiary. But if you do, you definitely need to understand its implications.
6 states? That's a pretty small club compared to the 12 plus DC for state estate taxes. But Maryland is on both lists, right? That's wild.
Yes, Maryland is the outlier. It's the only state that imposes both an estate tax and an inheritance tax. So if you're in Maryland, or if someone in Maryland is leaving you an inheritance, you're looking at potentially 2 layers of state-level death taxes. It can get complex very quickly there.
That's a really important detail for anyone living in or inheriting from someone in Maryland. So back to the relationship aspect for inheritance tax. Can you give us an example of how that plays out?
Certainly. Typically, spouses are fully exempt from inheritance tax in all states that have it. Many states also exempt direct lineal heirs. That means children, grandchildren, and sometimes parents. So if your mom leaves you money in Pennsylvania, for example, her direct descendants usually pay a lower rate, currently 4.5%. But if she leaves money to her sibling, or a niece or nephew, or especially an unrelated friend, the tax rate can jump significantly, sometimes up to 15% or even higher, depending on the state and the relationship.
Wow, so if I inherit from my aunt and I'm not considered a direct lineal heir, I could be paying a much higher percentage of that inheritance than my cousin who's her child. That's a huge difference for people to consider in their estate planning, especially if they plan to leave money to non-traditional beneficiaries or distant relatives.
Absolutely. It's a critical consideration. If you're planning to leave a significant amount to a friend or a beloved niece or nephew in an inheritance tax state, they could face a hefty tax bill. This is why having these conversations and proper planning is so crucial, not just for the estate itself, but for the financial well-being of your beneficiaries.
So just to recap the main difference, estate tax is on the entire estate's value and paid by the estate, while inheritance tax is on individual shares and paid by the beneficiary. And then there's the whole federal versus state layer to consider for both.
Exactly. You've got it down. And it's not just about knowing the difference, but understanding how it impacts your beneficiaries directly. This is why, even if you think your estate isn't big enough for federal estate tax, you still need to think about state-level implications, especially if you live in or have family in those specific states.
Okay, so we've covered the what and the who. Now let's talk about the how. How can people navigate this? Are there strategies to minimize these taxes or at least ensure things go smoothly for their loved ones?
Definitely, Sean. There are several powerful strategies. One of the simplest, if you have a larger estate and want to reduce its taxable value, is through gifting. You can gift a certain amount each year to as many people as you want, tax-free, without eating into your lifetime exemption. For 2024, that's $18,000 per person per year. So if you have multiple children, you can give each of them $18,000 every year, and that money is out of your estate.
That's a fantastic strategy for chipping away at the estate value over time, especially for parents or grandparents who want to help their family out while they're still alive. It's not just about tax planning, it's about seeing your loved ones enjoy the money.
Absolutely. Another powerful tool is trusts, specifically irrevocable trusts. Once you put assets into an irrevocable trust, they're generally no longer considered part of your taxable estate. This can be a more complex strategy, but for those with significant assets, it can offer substantial estate tax savings and provide control over how and when assets are distributed.
Trusts always sound so intimidating to people, but they really are just legal structures to manage assets. And an irrevocable trust, by its nature, means you can't change your mind once you've put assets in, which is why they work for tax purposes, right? Because you've truly given up control.
That's exactly it. You give up the right to change or revoke it, and that's what makes it effective for taking assets out of your estate for tax purposes. But because of that finality, it's crucial to set them up correctly with experienced legal and financial professionals. Another strategy involves life insurance.
Life insurance, how does that fit into minimizing estate or inheritance taxes?
Well, death benefit proceeds from life insurance are generally income tax-free to the beneficiaries. However, the proceeds can be included in your taxable estate if you own the policy directly. A common strategy to avoid this is to have an irrevocable life insurance trust, or ILIT, own the policy. When the ILIT owns the policy, the death benefit bypasses your estate entirely, providing liquidity to your beneficiaries potentially tax-free, which they can then use to pay any inheritance taxes, or even estate taxes if the estate is large enough to incur them.
That's really clever. So instead of the insurance proceeds adding to the estate's value and potentially triggering an estate tax or being directly subject to inheritance tax, the trust acts as a separate entity. It provides a tax-efficient way to ensure your beneficiaries have funds to cover any tax obligations or just to receive a larger inheritance overall.
Exactly. It's a powerful tool in sophisticated estate planning. And let's not forget charitable giving. If you're charitably inclined, leaving assets to qualified charities can significantly reduce the taxable value of your estate, because charitable bequests are typically deductible for estate tax purposes. It's a win-win. You support causes you care about, and your estate's tax burden is reduced.
That's a great point. For those with significant wealth, it's a way to leave a lasting legacy and manage taxes at the same time. What about a qualified personal residence trust, a QPRT? That's a mouthful.
It is a mouthful. A QPRT, or cupper as some call it, is a type of irrevocable trust specifically designed to remove the value of your primary residence or a vacation home from your taxable estate. You essentially transfer your home into the trust, but retain the right to live there for a specified number of years. After that period, the home passes to your beneficiaries, typically at a reduced taxable value, which can be a huge saving if your home has appreciated significantly.
That sounds like a great strategy for people whose main asset is their home and they want to pass it on to their children without a massive tax hit. You get to keep living in it for a while, and then it's out of your estate for good.
Precisely. It requires careful planning, of course, because if you don't outlive the term you set, the house comes back into your estate. But it's a powerful tool for specific situations. And finally, something simpler but often overlooked, making sure your asset valuations are accurate. Sometimes getting professional appraisals for unique assets can help establish a lower but fair market value, which can reduce the overall taxable estate.
That makes sense. You don't want to accidentally overvalue something and create a bigger tax bill than necessary. It really seems like the common thread here is proactive planning. Don't wait until it's too late.
Absolutely. The biggest mistake people make is either ignoring estate planning altogether or assuming that because they don't have a multi-million-dollar estate, they don't need to worry about any of this. But even if you're not facing federal estate tax, state estate taxes or inheritance taxes could still impact your beneficiaries significantly. And the planning isn't just about taxes. It's about ensuring your wishes are carried out smoothly.
I think that's such a crucial takeaway. It's not just for the super wealthy. Understanding these differences and taking steps to plan means you're providing clarity and potentially saving your loved ones a lot of stress and money during an already difficult time.
Exactly. Imagine your beneficiaries receiving a substantial inheritance only to find out they owe a large percentage of it in inheritance tax that they weren't expecting. That can create immediate financial strain. Proper planning can help them avoid that shock and make sure more of your legacy goes to them.
So, for anyone listening, if you're still feeling a bit lost, or if you've just realized you might live in one of those 6 states with an inheritance tax, or a state with a lower estate tax threshold, what's the first step you should take?
The absolute first step is to talk to a qualified financial advisor, an estate planning attorney, or both. They can assess your specific situation, your assets, your beneficiaries, and the state laws that apply to you. They can help you understand your current exposure and then craft a personalized plan to meet your goals, whether that's minimizing taxes, ensuring smooth asset transfer, or both.
Couldn't agree more. This isn't a DIY project for most people. The laws are complex and vary so much by state. Having a professional guide you through it can save you and your family immense headaches and potentially a lot of money down the line. It's an investment in your legacy and your loved one's future.
Think of it as peace of mind, knowing you've done what you can to secure your family's financial future, and understanding these death taxes instead of fearing them is incredibly empowering. It's not about avoiding taxes illegally, it's about smart legal planning.
Exactly. Well, Diane, this has been an incredibly informative and clarifying discussion. I think we've demystified a topic that intimidates a lot of people. Thanks for breaking it down for us.
My pleasure, Sean. It's an important conversation to have, and I hope our listeners feel more confident approaching their own estate planning after today.
Me too. And to all our listeners, thank you for tuning in. Remember to do your research, consult the experts, and start planning today for a smoother tomorrow. We'll catch you next time.